I'm Catherine Alford from millennialhomeowner.com. At Millennial Homeowner, we help millennials become smarter, happier homeowners. Remember, millennials, it's our time. Today, I want to talk about the typical down payment on a home. Now, the reason I want to talk about the typical down payment on a home is because I think there are a lot of misconceptions about down payments. After all, the most common number you hear when talking about down payments is 20%. You'll hear financial experts really talk about and encourage people to put 20% down on a home. Pretty much any article you'll read about buying a home talks about coming up with your 20% down payment. After all, that is the gold standard, and there are a few reasons for that. First of all, when you put 20% down on your home, that means that you own a good portion of one of the biggest investments you'll ever make. And it's really wise to own a good portion of that because of that. Any less than that, and the bank really is the entity that owns the house and not you. And so the goal, of course, over time is for you to become the sole owner of your home over time, and you're buying it back from the bank. But that 20% is actually not as common as you might think. In fact, according to a 2018 report from the National Association of Realtors, 55% of home buyers who used a mortgage to buy a home put down 6% or less. And that number goes up even more when it comes to first-time home buyers. In fact, 72% of first-time home buyers using a mortgage in 2018 put down 6% or less on their home. So the typical down payment on a house is actually right around that 6% mark. The vast majority of people who buy a house using a mortgage are not putting down 20%. They're not even putting down 10% or 9 or 8 or 7. The vast majority are putting down 6% or less. Now, at Millennial Homeowner, we do try to encourage our readers to put down a minimum of 10%. Again, it's because of the reasons I shared earlier, because it's a good idea to own a good chunk of the biggest investment you'll ever make. So what's the deal? What's the big difference between owning 6% of your house and 20% of your house? Like, what is in it for you if you are able to work hard and put that 20% down? And the biggest glaring difference between the 6% down people and the 20% down people is that when you are able to put 20% down on a house, you don't have to pay something called private mortgage insurance. This is an insurance policy that you will be required to take out on most mortgages if you put down less than 20%. This is insurance that does absolutely nothing to help you, but it protects the bank. Because if you put down less than 20% on your home, you are actually considered a riskier buyer. And so the bank wants to be protected in the case you cannot make your mortgage payments. That private mortgage insurance can be as much as 1% of your home's value. That means that potentially every year you could be spending hundreds or thousands of dollars paying private mortgage insurance. Now, that is money that doesn't go to pay down the principal of your house. It's not even money that goes to pay interest towards the bank. This is a separate cost that you will have to put into your monthly budget that does absolutely nothing to protect you and only protects the banks. That is the main key difference. Also, when you have 20% down on a home and couple that with excellent credit, you typically qualify for some of the best interest rates available to you. Interest rates matter because even saving 0.5% or 1% on your interest rate could mean saving thousands and thousands of dollars over the course of a 15, 20, or 30-year mortgage. So you came to this video because you probably wanted to find out the typical down payment that people make. So now you know it's actually not 20%. It's actually substantially lower than that. but hopefully I have shown you some of the reasons why it might be a good idea to take a pause and wait until you can save that 10% and ideally the 20% down payment, because you will get that benefit of not paying private mortgage insurance and having the best interest rates available to you. Now, there are very specific types of mortgages that won't require you to pay private mortgage insurance, but you will have to qualify for those. Some that I'm thinking of include VA loans and physicians mortgages. And again, that's a very specific type of consumer. And so if you are looking for a mortgage that doesn't require you to pay private mortgage insurance, you can do your research and see if there is a mortgage that offers that for you. Of course, I want to end by saying that buying a home is one of the biggest purchases you'll make. And at Millennial Homeowner, as I said, we're really dedicated to helping you become a smarter, happier homeowner. And there's no smarter homeowner than one who really takes the time to weigh their options and do their research when it comes to the mortgage process. Before you sign on that dotted line, make sure you really understand what you're signing and the type of mortgage loan that you're getting. What are the fees? How much will the bank earn in interest off of your payments? How long will it take for you to actually make a good dent in the principal of your home? And if you ask yourself all of these questions and you do your research, you will become a smart millennial homeowner who makes solid investments. Now, we have several resources available on our website, millennialhomeowner.com. We have a mortgage affordability calculator that can help you determine how much home you can actually afford, not what the bank says you can afford. And we have lots of other tools and checklists to help you on your homeowner journey. So please visit us at millennialhomeowner.com. And if this video was helpful for you, I encourage you to subscribe and like and hit the bell to be alerted for our new videos. We have videos that come out every week that will help you to become a smarter, happier millennial homeowner. Once again, I'm Catherine Alford. Thank you so much for watching. Bye.